One of the key question marks people will ask about is whether you want to be picking indices or whether you want to be picking individual stocks or sectors. And this is an absolutely crucial topic because most people will know, having got into investing, that it's quite difficult picking individual stocks, the individual winners. Generally, when you invest at first, you will always start to look out for your favorite names. You might say, I wear Nike trainers, so I think, I should invest in them. Or you should say, these big tech companies are going from strength to strength and invest in them. Or it might be a tip that someone tells you and says, this company is going to change the world, right? But it's easier said than done. And we can see that here, right? So essentially this chart highlights how many active fund managers beat or don't beat, so underperform the index as a whole. So essentially, if the S&P 500 has gone up 15%, and you look at the active fund managers whose job it is to beat the market, do they hit 15% and above, or are they below that level? More often than not, they're below that level. And these people are getting paid to do this for a living. And so what does this teach us? It teaches us that it's not that easy beating the market. It teaches us that stock picking and individual stocks can be quite difficult in nature. And so it highlights that from an investing standpoint, I would always think that, if you are into single name stocks, it also can make sense to be looking at the index as a whole to give yourself sort of a baseline level of growth that historically has been the case. And you sort of don't get yourself into a position where you might end up missing out on this winner, but you have this one and that one has underperformed. It's a difficult game investing, and ultimately I think a combination and greater diversification can benefit you in terms of investing. Of course, people always want higher returns, right? But higher returns also bring higher volatility a lot of times. So if I was to stick all of my money into one single stock because I think this is the one that's going to make it, it could be that one. It could be the outperformer, but it also could be the underperformer. And all of a sudden, your lack of diversification means that you underperform quite heavily against the market. So if active fund managers, professionals that do it, often underperform the market, it highlights just why the US market as a whole, the S&P 500, has been such a great investment over the years. And it doesn't necessarily take you having to go to a hedge fund manager to invest your money for you to be able to get good returns, because the S&P 500 has done exactly that. Now, if we look at the sort of summary of the breakdown of the sort of last decade in terms of how some of these different areas within the markets have performed, you can see here that the large cap stocks within the S&P 500 on average has been around 14% growth. The best year was 32%, the worst 14%. As we go down, you can see small cap US stocks, so the Russell 2000, more volatility, lower returns, but still very strong. International developed markets, you can see here we still see major volatility, but the annual return is nowhere near as good. And as you go down, emerging markets, 3.39 as an average. So ultimately, what we're looking at here is US exceptionalism. And the question mark of whether Donald Trump is going to end that remains, quite frankly. But this provides a guideline for an investor to say, how do I beat the market? Well, you can either be the market, so you can either just piggy bank on the S&P 500, for example, or you can try to look into specific areas. So you can say, I want to invest in US stocks, but I only want large caps. I want to invest in ETFs that are only in a certain sector, for example. I want to pick, a bundle of US stocks that are the outperformers over the past 10 years, for example, right? So you need to try and look into just weeding your way through it and perhaps just taking a view that you want to take the entire market, or take a view that you take part of your portfolio in the S&P 500 and then start to allocate out across historically outperforming stocks that have been very, very reliable in nature. if you look here, emerging markets have the potential for significant upside over the near term, but also on average haven't necessarily been that reliable year upon year investment. So probably emerging markets, international markets, sometimes they're better tradable than they are investable. If we look in terms of sector performance, this is another area that we want to look at, right? So if you want to look into investing into the S&P 500, you can invest in the index, or you can invest in specific sectors. So which markets have done particularly well? Well, information technology, you can see here, if we're looking over the years 2017 onwards, information technology has been the outperformer for 4 of those years, and it came second in line for 2024. So that is a clear outperformer. Of course, tech names are now such a huge weighting within the market as a whole that essentially when the market sells off, tech sells off in a big way. And also you have huge valuations attached to them right now. So again, when markets start to have jitters, then you often see those big tech names start to come down because people think that they're priced to perfection, essentially. What else sort of jumps out at us? Sort of telecoms, which is along the same kind of line, that's sort of along the tech company line. Aside from that, consumer discretionary, sort of around your 2010s to 2015s in particular. Then in 2017, 2018, they were sort of third in line. Over the last 2 years, they were third and fourth. So that's another area of potential strength. That's been a big underperformer this year. You can see year to date, consumer discretionary at the bottom of the pack alongside information technology. So you're talking about areas that are general outperformers, but we're seeing them pull back right now. So if we're looking at areas of strength, you want to look at historical areas of strength and try to gauge whether what we're seeing right now might be a pullback and a retracement within that wider trend or not. But certainly I would say that just investing in everything can do well. But also if you want to go granular, rather than just picking just 1 or 2 names, you can also look at sectors as a whole and try and build some diversification in that way. This is the breakdown for exactly that. So you can see here, consumer discretionary, information technology. Those are the 2 outperformers here. Aside from that, if you're looking at the sort of index as a whole, you can see that third in line is the S&P as a whole. So that really highlights how it's sort of, when there's years that the sort of consumer discretionary and the big tech names are underperforming, you see the outperformance from the other areas that then pick it up. And that's why the sort of S&P 500 as a whole has been a really big, strong performer over the years. Now, this is a sort of nod to that impact that I think will be felt from AI going forward. And this highlights the recent net profit margins by sector over in the US. This is expected for Q1 under FactSet. So for Q1 of this year, it's the sort of dark bar, and then the 5-year average is the green bar. Now, what we want to see is a sector where you're seeing improved margins. Some of them might just come down to what is happening within the sort of global economy right now. For example, the financials have got a better margin right now compared to the 5-year average, and that will come down to the fact that rates are relatively elevated right now, and with high rates come high margins. But I think margins are going to be stronger going forward with artificial intelligence managing to provide the basis for that growth, undercutting the amount of costs that these businesses have and hopefully raising profitability within the market. But certainly I think this net profit margin metric is going to be a key one going forward as we try to gauge the benefits from AI for different sectors in particular.